Welcome to OpenECRI's Trader Training. My name is Toby Gennaro. What I'll be talking about today is how to read market trends. We'll look at the basics of how strong trends are formed through market price action so that we can effectively read market direction and decide who is in control at any moment in time. Is it the bulls, the bears, or possibly a neutral market with no one in control? Let's take a look. Let's first look at two chart examples of basic trends and what actually makes a trend a trend. In this first example, we have a classic uptrend. Let's look for the building blocks in the price action to determine the strength of this trend. The very first thing we notice here is that price action is going up. The question you want to ask yourself is, how is it going up? Is the price action skyrocketing with large candles, or is it sustainable with consistent buying pressure and occasional pullbacks to price support? Is the price action consistently making higher highs and higher lows? The definition of an uptrend is very simple, and many people already know it, but there is a big difference between knowing a definition and having mastered its practical implementation. The definition of higher highs and higher lows is worth committing to memory, and I would also encourage you to make a note that mastering the price action trend is one of the most important things you can ever do as a technical trader. This video introduces you to some important yet basic concepts that you'll need to practice. Commit to practice and mastery, not just remembering the definition. In this downtrend example, do we notice those same characteristics? In this case, you will. Price is forming successive lower highs and lower lows that create this downtrending chart. Are there controlled pullbacks to price resistance levels? Are there any extremely large candles that would signify an end to this trend and a potential reversal? And what I mean by large candles, this is one of those things that is kind of a common sense thing. You're looking at each candle relative to the surrounding candles to get that answer. This is usually accompanied by very big and fast moves. For example, moves that happen within one or two candles. These moves often occur near the end of a trend and are an early indication of a trend that is about to reverse. But in this case, there is nothing out of the ordinary in this trend with any of the candles, so we would stick with the downtrend in this chart and continue with the short trade. As you're identifying trends and reading the price action, here's one thing that you don't want to do when reading market trends. Don't use sloping trend lines. Many traders often talk about using sloping trend lines on their charts. Even though there is some validity to a sloping trend line, they have a tendency to be very subjective, and it becomes difficult to find your entry or exit point based on a sloping line. Another issue is that there tends to be several different trend lines in every trend. So it's natural to begin drawing lines through different points, and the chart ends up being a bit messy with no clear distinction or any way to identify a precise entry, exit, or stop loss with a high degree of consistency. Additionally, every trader may then be looking at a slightly different sloping trend line, which is not what we want when looking for buy-sell signals, as we want to be looking to trade with as much agreement from other traders as possible. The more people there are doing the same thing at the same point, the bigger the subsequent move is likely to be. The only lines that we recommend drawing on your charts are horizontal ones, where we match up price support and resistance levels as we have done here. In this trend formation, there are two horizontal lines in the price action that identify two consolidation zones or possible continuation patterns. These horizontal levels are preferable to sloping levels because they provide us a very exact price level that is objective and not open to interpretation like a sloping line. This gives us confidence that more technical traders are trading at these specific price levels, and this helps us to understand the trend pattern while also starting to help us identify possible entry, exit, and stop loss locations based on specific price action. So in order to trade in the direction of the trend or in the direction of the order flow, we need to be assured that we are all looking at the same thing on our charts without ambiguity. And that's how we follow a trend. So keep in mind, this is just one aspect of identifying strong trends. If you're interested in learning more about technical trading, including trend reversals and identifying entry and exit points within a trend, check out the OpenECRI website under Education and look for other trading videos and webinars, or you can call customer service for more information and educational events. Thanks for watching OpenECRI's Trading Education.